You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for Options Bootcamp, the premier program for options education out there. For all of you out there, maybe you're a stock trader looking to dip your toes into those options waters. Maybe you've tried, maybe you've waded into that pool. Maybe you found it a little bit deeper than you thought. You want some help mastering all your different strokes. Don't worry, we're here to help you out. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned network. I've said it before. I will say it again. If you're just listening to Boot Camp, man, you are missing out on a whole heck of a lot, including this week. You missed our massive, unprecedented, once-in-a-lifetime Option Block 1,000th episode spectacular. Yes, 1,000 episodes, listeners. That show has been running for over a decade now. Crazy. Just think about that. How many things in life that you love do 1,000 of anything? Your favorite TV shows, they haven't done 1,000 episodes. Your favorite whatever, there's not 1,000 of them. 1,000 episodes of the Option Block. We went for 3+ hours. We had tons of special guests. It was fantastic. Hopefully you guys checked it out. If you're listening to the full network, if you're not listening to the full network, just Boot Camp, you missed it. You also missed out on the launch of the newest addition to the network, which I think is something that's really going to interest the audience of this program, Options Insider Plus and Options Insider Pro. Yes, people have been asking us for this for pretty much 14 years since we launched, listeners, and we finally launched it this past Monday during the live special. It was great. We actually gave away some great prizes during the special for folks who were signing up. Glad to see so many people were excited and diving in. You can learn for yourselves what's all about. Go to theoptionsinsider.com. Go to the /shop link. It'll explain it all to you. In a nutshell, the plus is for people who want to engage a little bit more of the network. They like it. They like all the podcasts. They want to get a little bit more in their lives, particularly in the live front. They want to come in and get everything live immediate. They don't want to wait for the podcast to come out. Then the plus is for you. You get some cool content logins at the website, all kinds of good stuff there too. Then you want to take it to the next level. You want to go pro. That's what the pro is for. That's for folks who want exclusive content. So they get the full network, plus they're going to get the pro. And what does that include? Well, it's kicking off with, I think for this audience of this show, you folks bombard us with questions all the time. One of the first things we're going to do with the pro is have a really cool expert Q&A. We're going to bring in options experts from all over the globe, and you're going to get to pick their brains just for you guys. So just for your pro folks. Whatever questions to your heart's content, trade structure, strategy, education, a whole bunch more. It's going to be awesome. That's exclusively for our pro people. We're also going to bring back and launch some exclusive shows. The first one we're doing is bringing back an old favorite that we used to do with the folks at TD Ameritrade, used to do it exclusively for their clients, actually, which was Options Oddities. And we had to put it on hiatus a few years ago. People loved it. It's an unusual activity program. We're bringing that back as well. So if you go for the pro, you're going to get all that cool stuff and a whole bunch more. There's a lot coming. This is just the pre-launch. This goes official next Tuesday, actually, June 1st. That's when it launches live, and it's going to have all this kind of great content. And there's more to come. This is just the beginning. So if you get in there now, have a ball. You get to be a network founder if you join up now. We're going to make some all sorts of cool gear. We got designers working on it right now to delineate you as the cool person that you are, the network founder. So get on over there, theoptionsinsider.com/shop. Check out the Plus, check out the Pro. Let us know if you have any questions. If one of those is right for you, dive in. What do you say, Mr. Dan? You think you're going to be up for one of those expert Q&A sessions down the road? Can you handle that, sir? People coming at you like that?
Man, that sounds really, really fun. I can't wait. I'm really looking forward to that.
It's like what we do here on the show, but turned up to 11. Speaking of turning up to 11, you folks have gone off to 11 on your questions and comments. A lot of them out of themes. We're going to get to that. But first, Dan, we're coming out of the heels of yet another crazy topsy-turvy time in the marketplace. Vol kind of got back up there, then it's coming back down again. Markets were selling off. Now they're rallying again. We saw an aggressive, pretty much 50% wipeout in the crypto space. Some of that coming back now as well. So a lot's happened since the last time you and I gathered here together on the show. What's been lighting up your tape and indeed the tapes of your mentees over there at MTM since we last spoke, sir?
Man, I do a lot with these, kind of like short squeeze type candidates and even some that maybe aren't as short squeeze candidates anymore, but that's how they got on my radar. And I'm looking pretty close at a couple of them. ASO, which is one which is up about 50% when I started looking at it, but it wasn't one of these big spikes. It kind of grinded higher. And it's because, I was saying from the beginning, look, this is a company that makes money. Why do they have such huge short interest rather? So that's been an interesting one to watch. It's been kind of on a tear, steady grind higher. And then Rocket Mortgages, or Rocket Companies, or whatever the parent company is called, Rocket, RKT, that one has been pretty interesting too. It's one of these where the shorts just love to short it, and it doesn't make a whole bunch of sense why either, because they're making money too by 2 cents. And like the way the stock reacted, you would have thought that like their CEO and entire board went down in flames in a plane crash or something, into their headquarters, if that's possible to happen. And today it's kind of getting that pop back higher, which I was kind of waiting for here. It just seems so absurd that it got hammered so much, but I think it was just the shorts trying to be short, and it ended up pushing it down more.
Yeah, these crazy names out there. All the kiddies loving to fight against the squeezes. I saw about people tweeting yesterday. We just have to all hold and we'll be okay. It's like this weird, almost religion out there these days. You buy and you hold. And if you all do it together, then it could work out all right. You know what else works out all right when you do it together, listeners? It's your questions. You guys have deluged us. Let's get to it. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Let's do it. Let's get to your questions. You got a bunch of them. A lot of them on the theme. Seem like you want us to go back and address covered calls some more. So we're going to do that today on the show. You people speak and we listen here on the show. Before we do that, Dan, I'm sure you got a lot of cool questions coming across your radar and in your chat rooms and in your sessions over the course of the past week or two. What would you say really rose to the top? What's the most interesting, the most intriguing question you were asked over the past week, sir?
Well, let me tell you, Mark, I had a question just today from someone who was interested in like a whole bunch of gamma scalping sort of stuff, like real cerebral volatility trading. And this person is not really new to options or anything, but hasn't really gotten over the hump just yet. Like still in the learning process and not feeling like this person has that level of success just yet. Which, if you're doing it right, you never attain. You're always trying to get better. But holy cow, man! I mean, for me, I say when a retail person comes to me, in fact, even if they're super successful already, my best advice for gamma scalping is just let it be, man. Like, you're never going to be able to gamma scalp as a retail trader. I have trained, I want to say 3 traders, and they were the elite of the elite. You know, they were 3 of the best people that I've ever had on how to gamma scalp in a retail trading account, and none of them could make it work. So it's just too tough. Like, it's not really designed for a retail account, even if you have retail portfolio margining. There's plenty of ways to make money out there, and that is one of the hardest ones to do.
Yeah, even if you can make it work, it's so capital intensive, right? For a retail person that it's not worth, the juice is not worth the squeeze, listeners. If you want to tie up your entire account, which is going to have to be sizable to begin with, just to try to get a few ticks around this one position, it's not going to work out. So I'm with you there. It's cool. It's something we used to do on the floor a lot, but obviously we had very specific leverage, specific margin, specific access on the floor, specific capital we had access to as market makers that retail just simply doesn't. So yeah, it's when we still get a lot every now, I wouldn't say a lot, every now and then we still get the question about, how do I do that? What is this? And we're happy to explain it to you. And we have on this show in the past, if you don't know what gamma scalping is, listeners, search some of our archives. It's all in there, but it's not something for even the most well-capitalized of retail traders. And if you're going to do that, there's other things you could probably be putting that capital to that probably will be more worth your while. All right, Dan, we got a bit of a theme here to some of our questions. We talked recently about covered calls and when to close them, when to roll them recently. And that, as I kind of expected, set off a flurry of additional questions and related comments and discussions on the topic. So what do you say, Dan? You ready to bite off some more covered call discussion today, sir?
Let's do it, man. Let's do it.
All right, here we go. First up, we got OJT87. He says, thanks for talking about covered calls. You need a covered call show on the network. Covered calls show, all about covered calls. I don't know, Dan. What do you think? That might get old pretty quick. What do you think? I don't know if you could do a show every week. Now you write this strike. What would be new about the covered call show every week, Dan?
It'd be interesting. I mean, man, I'll tell you, I spent a lot of time on covered calls, trading myself and teaching it. That's kind of one of our, that's more for the investors, a little bit more basic. We do a lot of advanced stuff more so, but I don't know. It might be possible. I'm just saying it might be possible. I think we can talk about it.
I think demand-wise, there certainly could be a show there. People love covered calls. I guess what you'd have to do is probably have like our suggested covered call of the week, something like that. It's the only way you could really fill. It'd have to be more of a trade recommendation type show. Just talking the nuances of covered calls week in and week out, it would get old pretty quick. Now you should roll again. But speaking of that, he has his email goes on. He says, my question has to do with rolling. I agree with Dan that you should roll out and up with the call. That's kind of what we talked about on the show last time, listeners. If once it hits your strike, you should roll out and up. Give yourself a little bit more time, a little bit more room. He says, I tend to repeat what I had on before. That's what I was talking about on the show last time, too. He says, so if it was a weekly 5% out of the money covered call, then I roll it out another week and another 5%. If a monthly 10%, then I roll out another month, another 10%. That seems to work for me, but it almost seems too simplistic. Are there some nuances that I'm missing? People sometimes go into the weeds too much and they try to worry about they're not as sophisticated as they need to be with something they're doing isn't complex enough. For a show like this, we always say, the old maxim of KISS, keep it simple, stupid. It works. And that's what we said last time about when it touches the strike, then you roll. That's simple. That's straightforward. It works. It's effective. I think what you're doing here, Mr. or Mrs. OJT87, you also say it works for you. So why do you want to change it? But I think that's a good approach for a lot of the listeners of this show as well. You want to keep it somewhat standardized, something you can easily replicate time and again, and something that's easy to understand. And so if in your approach, if you write a 5% out of the money covered calls in the weeklies, it hits your strike within the lifespan of that option, you roll out another week and go another 5%. That makes a heck of a lot of sense. It's easy for people to understand, and it tends to work. You don't have to, if it ain't broke, don't fix it, to throw out a lot of cliches here today. Now, the scenario where maybe the stock is really on a rampage, and then maybe you need to change your outlook a little bit, that's certainly one wrench that could be thrown into these works. And maybe you need to go a little bit farther out because the stock is really running. So that's one thing to consider. But outside of that, if it's just a regular scenario, it kind of just bumps your strike and you roll and decide to keep going again. The stock doesn't seem to be trending aggressively in one direction. It's kind of just vacillating around a certain level. Then, yeah, I think rinsing and repeating can certainly work. What do you say here, Dan? He agrees with you on rolling up and out, and he likes to, when he does roll up and out, he pretty much does what he did before again. What do you think about that strategy?
Well, I mean, look, I love methodology. And honestly, that's something that I've been working on myself, is just really tightening up my methodologies even more, right? So there's nothing wrong with that. But I mean, I would say one little fine tune on here, 5% or 10%. So, you have implied volatility, which is stated in terms of annualized standard deviation. And it is for a reason, because 5% on a weekly in one stock, you might get a nice, decent premium that's far enough from the money, and it meets that nice little sweet spot criteria. Low enough strike to get a big premium, high enough strike for some room to run. But there might be another stock where 5% on a weekly is, you're selling it at a nickel on $100 stock or something, and it just doesn't make any sense at all based on how it's moving. Or who knows? I mean, it might be some really wily stock that moves around like crazy, and 5% out of the money is ridiculous. It's just way too close to the money. So I would just say maybe you could fine tune a little bit and not use percentages. I mean, some people will go and they'll use and I almost don't even want to say this, because even though it's a little better than percentages, it's still not the right answer as far as I'm concerned. But, some people use delta because that can be thought of a little bit wrongly, but thought of as a proxy of the likelihood of an option expiring in the money. I personally just like to look at it, look at how the stock's trading, look at what percentage premium of the underlying I can collect. And, if I'm selling a weekly option, if I can collect like 0.9% in a week or even in 2 weeks, I'm pretty darn good with that. I mean, if I can collect, close to 1% every 2 weeks, geez, man, like that works. I mean, there will be some times when I have to adjust and it doesn't work out. But I mean, if that nets me an extra 15% a year on my investment, I'm great with it. So anyway, the moral to the story is I would shy a little bit away from just plain old percentages and just look at it, just look, how much premium am I taking in, and does that make sense for how the stock's trading? And let me throw one more thing in too. There's going to be some times when you want to put your hands in your pockets with the covered call strategy as well. Now, you don't want to be timing the market too much with covered calls. This is like in augmentation of the buy and hold strategy. But I have two good examples where I've done that recently over the last year or so. And one was in Rocket Mortgages, right? That was a short squeeze candidate. And then it kind of pulled back, and I was like, you know what? The IV is so ridiculously high. I'm just going to sit, this is when it got nailed, or this is before earnings. The IV is so ridiculously high, I'm going to sell covered calls. And if it does spike up, I don't care. You can take it. I'm still going to make a good percentage profit. And then when it got hit after earnings, I was like, this doesn't make any sense that it got hit. And now implied volatility squashed. I'm just going to sit on my hands, and I think it'll probably grind its way higher, which as of today it is. And I also did this, I think I mentioned on the show, during the coronavirus situation, where I was literally out of my long positions. I let myself get assigned on covered calls before the coronavirus hit, which, I'm not saying that because I'm a genius. There's a whole bunch of luck involved in there, kind of a long story. But I ended up just selling puts, just scaling into puts at consecutively lower strikes. And then once I got my whole position back, I sat on my hands because I figured it would go back up, and ended up being right on that one too, and didn't start selling calls until it was like, pretty close to its high, and then I got back into the call. So sometimes you kind of want to pull back and sit on your hands with it too.
Yeah, you could probably do a whole show just on this one question. I'm with Dan. I think if you want to reconsider, that's why I touched on before. If you are hitting your strike really quickly every time you're doing this, maybe you want to reconsider, what's going on, what strike you're looking at, how far out of the money you want to be, and those sorts of things. So if you just blindly sticking to whatever I like 5%, and that's what you're doing every time, regardless of situation. If that's what you're doing, then no, you need to reconsider. But if it's working for you, like I said, you say it is, and it's easy to understand, and it's getting the results you want, there's no need to fix what ain't broke. All right, Angelo, next up. I guess this is more of a comment than a question. He says, similar, everyone's got covered calls in the brain, Dan. He says, I love covered calls, but I can't take the tax hit on my stocks that are sitting on some pretty nice gains. Well, you're probably not alone right now, Angelo. He goes on to say, I don't move my strikes up, but instead tend to roll them more aggressively. So if the stock gets within a few points of my strike, I'm already rolling up. I don't wait for the options to go in the money. Sensible? Question mark. Well, yeah, we kind of touched on this on the last show as well. That's one of the scenarios I mentioned where for certain people, whether you're like Angelo or you're sitting on some pretty big gains in the stock, you don't really want to take that tax hit right now. Or maybe you're in a rare situation, you're an executive of a company or whatever it is, you can't let the stock go. For whatever reason, you're prohibited from selling that underlying. Then you need to do something like this. My first suggestion was to migrate your covered call liquidity a little bit farther out of the money. You're not going to get the returns you maybe want, but on the flip side, if that's what you're really concerned about, then that will certainly make it a little bit less likely your stock will get called away. Another alternative is, of course, not to do the covered call at all, but we're going to proceed like you want that additional income. But if you're not going to do what I said earlier, which is migrate your liquidity a little bit farther out, then you have to do Angelo's thing. You have to do one or the other. You have to, if you're going to keep your regular strike, I really want my 2.5% out of the money call, whatever your flavor is of covered call that you want to do. And maybe you're in a pretty volatile name. You have a high chance of hitting that strike, then you're going to have to babysit it very aggressively. And the second you get to that strike, or in case of Angelo, he does it a few points before, you're going to have to roll. So as long as you're comfortable doing that, then yeah, you can choose whatever strike you want for your covered call. You just have to do one of these things. You have to either move your liquidity a little bit farther out, give yourself some more wiggle room, or you have to be on top of it. And either way, even if you're moving that liquidity out, you still, around expiration, you still have to be on top of it. It is the rare scenario. You're not paying attention. You think it's a set it and forget it type trade. And next thing you know, the stock is 1 penny through your strike on expiration, and bam, there goes your stock. So you have to babysit it on expiration regardless, and you definitely have to babysit it more if you're not going to roll your liquidity a little bit farther away from the money. Dan, what are your thoughts on people who are in these types of tax restricted or other type of restricted situations? What do you typically recommend for them? And what do you think about what Angelo's doing? He's keeping his regular strikes. He just rolls aggressively.
Yeah, I don't think that that's a bad idea at all. And there's I've said this a lot of times before, there's nothing wrong with leaving money on the table with the covered call position. Like, you're never going to keep your entire premium every single time. That's a dumb game to try and play. Like, it's fine to leave money on the table. That's totally part of it for sure. And I will not give a lot of details on this just because I want to help people, and I don't want to unhelp people by giving a little bit of advice and people following up on it without doing their homework. But listen, there's probably nothing you can do besides what you're doing, and what you're doing makes a lot of sense to me. But call your broker and see if there is any things that you might be able to do as far as playing with the playing with which shares get assigned. Like, there might be ways. Most brokers are going to say no, and they're going to say, I don't know what you're talking about. If you just call into the regular helpline, they're going to say, no, I don't know what you're talking about. You really have to ask for ask for the options desk, ask for the smartest guy on the options desk, and then ask for his boss. And just explain your situation. Say, hey, look, is there any way where if I get assigned, I can swap out these shares with other shares and get assigned on different shares so that I don't have to pay taxes on it? I have never done this personally, but I know a guy who used to own a brokerage firm who would do this for some of his clients. And talk to your broker about it. Talk to your broker about it. There's nothing guaranteed. They're probably going to say no, but I mean, if it can help you, you might as well have that conversation.
Doesn't cost you anything to call, right? And maybe you're the one guy who gets it. So whatever broker it is, and yeah, okay, we'll let you choose these shares that are, let's say, a little bit less of a tax hit or something along those lines. Again, I think with Dan, probably most brokers are probably not going to know what the heck you're talking about if you get like just the Joe guy on the help desk. But if you get a savvy fellow and they bump you up a little bit, maybe you have a little bit bigger account, maybe you're a little bit more active. Maybe, again, it doesn't hurt to call. You should probably call your broker every now and then anyway, just kind of check in and say, hey, maybe they have something they can do for you on the margin front or other things. You don't know until you call and contact them. And certainly if you have options that are long premium and you're getting around expiration, don't forget you can call and give contra exercise instructions as well. So if you don't want your options to be exercised if they go a penny or two in the money, you can tell your broker that as well. And that's something you usually do have to call for. You can't do that online on most brokers. All right, more covered calls. You folks got covered calls on the brain. Ilthim wants to know, why not write a call vertical instead of a simple covered call if you are worried about the stock getting called away? That allows you to still have some income and write the strike that you actually want instead of writing a worthless 20% out of the money covered call because you're scared to lose your stock. Yeah, that's an alternative. We didn't really have time to get to that on the last show, but covered call vertical, effectively you can call it, is another way you can go. I think you can maybe see the chink in your armor there, Iltham, as well. You have that strike differential. So let's say you sell the 110, 115 vertical, right? Instead of just selling the 110 covered call and your XYZ is at 100, and then XYZ closes at 112 and a half on expiration. That's the chink in the covered call vertical armor. That situation, if you're not pretty quick on the trigger finger, guess what's happening? Your stock's still getting called away. So it doesn't solve all of your problems, Ilthim, easy for me to say. But it can help if you have the scenario where your stock is just wildly outperforming to the upside. That vertical can help you participate again. So it's good for that. It's not quite the silver bullet, though, for if you're worried about tax issues. The vertical ain't going to do it. At least not all the time. Mr. Passarelli, what do you think about covered call verticals instead of just covered calls, sir? When do you like to use them?
So a covered call is part of your investing strategy. A covered call is intended to be a long-term position, and most of the time, it's augmenting a position that you already have by using options to make that position better. If you're a trader and you're just like, yeah, hey, I think the stock is going to go up a little bit up to this point. I know the covered call would be a way to play it. Like, no, like if it's a short term like trade, you're 100% way, way, way better off doing a bull call spread instead. So yeah, like trader or investor, trader, covered call, investor, bull call spread. That's my rule.
We got more covered calls. Let's finish up on this one, Dan. We got covered calls for days over here. This is kind of an old school one. We've touched on this many times, you and I. It seems like the audience, Dan, gets a little bit confused when we're talking about the synthetics, about things on the same strike. I think they don't think of it that way. I think that's why we had all those discussions about credit spreads and debit spreads and how could the same thing. They think of the out of the money version. They don't think of what we're talking about, these synthetic positions at the same strike. And that's kind of what I think Beats is talking about here as well. Beats wants to know very simply, why do people always say selling covered calls and selling naked puts are the same thing? We've broken this down before, Dan. It's been a little while since we've actually broken it down for the people. So let's leave them on this note then. Let's go back. Let's go old school, Dan. When, all these seminars, all the speeches, all the educational things we do, and we always say, who sells covered calls, and people raise their hand. Then we say, who sells short puts, and people don't raise their hand. And then we say, ha, they're the same thing. Maybe I say, aha, I don't know if you do. But what are we talking about, Dan? What is going on there?
Yeah, so, this is something that, it's not going to be just something that's intuitive where you're like, oh, yeah, I watched YouTube video on how to trade covered calls, and this just makes perfect sense and comes natural to you. It's not. It's something that you kind of have to dig into a little bit. And that's why, like in my book, Trading Option Greeks, I probably have realistically a good 4 chapters devoted to things around this. Like there's one that's 100% on synthetics, but then there's probably about two or three other ones that like still kind of touch on some of this, interest rate and dividend, like everything involved in the synthetic relationship. But Beats, that's the answer. A covered call is synthetically equivalent to selling a naked put, but in practice, and if you don't have my book, Trading Option Greeks, if you're looking for it, get it on Amazon. It's the cheapest you can get it. They can sell it cheaper than I can. I would lose money if I tried to match them, which I don't know what that says about the publishing business. But so here's the thing. In practice, covered calls and naked puts are functionally a little bit different because people typically sell out of the money options. They'll sell a strike of covered calls above where the stock is trading. But when we think about naked puts, we think about selling a strike below where the stock is trading. So those two things are not equal. But if we're using the same strike and the same expiration, then yeah, they're synthetic equivalents. So bone up on some of that. It's something that will make you a better trader. It really will. And that goes for anybody, for sure.
Yeah, definitely take your time to review it. Go to your brokerage platform of choice, Beats. Hopefully they have something that will do a basic risk diagramming for you, the P&L. I don't like P&L graphs. I think they leave out a lot of the equation. But for something like this that wants to exemplify why two things are similar, if not identical, pull up the P&L graph for the short put, then pull up the P&L graph for the covered call. You can also look this up. You can go to Investopedia. You can go to optionseducation.org, the OICs. They all have these P&L graphs you can look up. And you just put them side by side, and that will give you a good starting point. Say, oh, maybe they are kind of the same thing. And you can start thinking intuitively of why that is, right? What are the risks on the covered call position, for example? Well, the primary risk, you own a whole bunch of stock, it could go down, right? What's the primary risk on the put? Well, you can blow through your strike and keep going down. So these are the things you'll start to think about. They'll start to intuitively make sense here. And if you're still not sure what we're talking about, go check out some of the early episodes of this program, and of course Dan's book, where we talk about synthetics in a lot more detail. Unfortunately, that music means we come to the end of this program. Man, you guys really got covered calls on the brain. I got a feeling we'll be talking about this again. But don't worry, if you got more questions, we'll be back again next week. We got more shows throughout the week here. Again, if you're not just listening to Boot Camp, you're missing out, including since you guys like questions so much. And since so many people have so many these days, it's understandable. I said it's for our pro members coming up. We're going to have those cool pro Q&A sessions. You get all these questions off your chest. Well, we're going to make the first one open to everybody so you can see what the heck's going on. It's going to be next Tuesday, June 1st. We're still lining up some fun people there. So get your questions ready. Bring them. Come at us. You got questions. It could be covered calls. It could be something else. We don't judge. Come at us. We have some great people there to discuss and answer those questions for you so you can see what we have planned, what's in the works for the pro offering down the road. Before we go, Mr. Dan, if folks maybe want to check out your books or maybe they want to talk to you in person, or I guess in person virtually these days, where should they go? What should they do?
Well, let me tell you, if you want to chat in person virtually, you should definitely consider joining our MTM Summer Summit, which is, oh my God, it's coming up. I'm in PowerPoint heaven right now, just spending a lot of time putting together those classes because it's so exciting. That is June 3rd, 4th, and 5th. There are 3 full days of classes, and we actually still have a ridiculously sweet deal going on that. But you kind of have to jump on it really, really fast and take some action. It's just go to markettaker.com, 2 T's in a row, markettaker.com/summit, and join up within the next couple of days and grab that super sweet deal right now. That's oh man, that's an amazing class.
markettaker.com/summit. I've wanted to go to this forever, listeners. Dan has never let me in, so I've always missed it. All the cool things that they've done. Now it sounds like he's doing something even cooler. I won't be there again. somehow my code doesn't work. I don't get it. So head on over, check it out for yourselves. It'll let you in, I'm sure. MarketTaker2Ts.com is the place to go on behalf of Mr. P and indeed myself. I want to thank all of you out there who continue to just deluge us with questions. Remember, you got more questions. Come at us next Tuesday, June 1st. Get a taste of what the pro is going to be like out there. And then, of course, you can come back at us next Wednesday, another Education Wednesday, another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.